Welcome, everyone. Today, we're diving deep into the fundamentals of a company that has literally become a massive proxy for India's Make in India boom. We're talking about Interarch Building Solutions. Look, if you've been tracking the incredible growth of physical infrastructure and manufacturing across India lately, this is a business model you absolutely need to understand.
To keep things crisp, here's our roadmap for today's explainer. We'll quickly cover the PEB revolution, the financial core, the order book, capacity and expansion, and finally, analyst valuations. Let's jump right in.
Section 1. The PE revolution and macro tailwinds.
So India's current industrial capex cycle, it's not just about your standard warehouses anymore. We're seeing massive, rapid investments in e-commerce logistics, high-tech data centers, and super complex semiconductor and EV manufacturing plants. And you know what all these Make in India projects have in common? They need to be built incredibly fast. Speed is literally everything right now. And that's exactly where Interarch's biggest moat comes into play. Pre-engineered buildings, or PEBs. Instead of pouring concrete and waiting around for months, these are factory-fabricated modular steel structures. The biggest takeaway here? PEBs can slash construction time by up to 50% compared to traditional concrete methods. I mean, for a multi-million-dollar semiconductor plant, saving time directly translates to saving serious money.
Interarch is absolutely capitalizing on this trend. Their focus is crystal clear. A massive 84% of their total revenue comes directly from this high-growth PEB segment. With 4 decades of experience under their belt, they're now the second-largest integrated PEB player in India, handling everything from the initial design all the way to on-site erection.
Moving on to Section 2, the financial core and margin health. Let's look at the numbers. The market cap sits at roughly 3,228 crore rupees, trading at a PE of 23.6. But the real magic here is in their return ratios. For a capital-intensive manufacturing business, a return on capital employed of 22.8% and a return on equity of 16.8%, that is incredibly strong. And the biggest green flag for investors? Their balance sheet is almost completely debt-free. They are literally funding their own growth. And the result of all that efficiency is right here, 84.5%. That staggering number is Interarch's 5-year profit compound annual growth rate. They aren't just growing revenue, they have dramatically compounded their profitability over the last half-decade. Just look at their latest Q2 FY26 results. It was their best quarterly performance on record. Revenue jumped 52% year-on-year, surging from 323 crores straight up to 491 crore rupees. And thanks to this fast execution and scaling capacity, management actually upgraded their full-year FY26 revenue growth guidance to over 20%.
Section 3, the order book and execution speed.
Currently, their total order book stands at a massive 1,695 crore rupees. Now, you might be wondering, doesn't that only give about 8 to 10 months of revenue visibility? Well, yes, but that's actually a deliberate strategy. Because their project completion cycle is so fast, management intentionally avoids booking long-term orders to protect themselves from future material price fluctuations. It's a true testament to their incredible execution efficiency. The future pipeline is equally massive, with 1,200 crores in Phase 1 and another 1,000 crores in Phase 2. But the most positive indicator here? Their 80 to 85% repeat customer rate. When marquee clients like Havells and Jindal Stainless keep coming back, it proves top-tier execution quality. Plus, they're now targeting higher-margin export opportunities, already securing orders in markets like Myanmar and Ghana.
All right, Section 4, capacity expansion strategy.
So right now, their installed capacity is 200,000 metric tons, and they're operating at near peak utilization, which, by the way, is often a strong leading indicator of future earnings growth. To meet this massive incoming demand, they're aggressively expanding. The target is to push PEB capacity to 240,000 metric tons and heavy structures to 45,000 metric tons, setting up brand new plants in Gujarat and Andhra Pradesh.
To fund this aggressive expansion, they recently raised 100 crore rupees through a QIP. From a forensic analysis standpoint, this is great news. Management has made it crystal clear that this capital is strictly to fast-track and prepone their capex by a year, not to plug any hidden working capital gaps.
Finally, Section 5, valuations and analyst targets.
In this technical chart from the Ambit report, you can clearly see the price action. The red line is Interarch, and the black line is the broader Sensex. The market has visibly rewarded their solid execution and order book growth, with the stock significantly outperforming the broader market in recent months.
Now, let's take a look at the forward guidance from two major brokerages covering the stock, Anand Rathi and Mongol Keshav.
Looking at the data neutrally, Anand Rathi initiated a buy rating with a target of 3,000 rupees, assigning a premium multiple of 26 times one-year forward earnings because of their superior ROE. Meanwhile, Mongol Keshav also gave a buy rating noting the strong capacity expansion and set a target of 2,540 rupees based on a 17.5 times multiple on FY28 earnings.
But look, no fundamental analysis is complete without understanding the risks. For a PBEB company, the biggest threat is raw material cost, specifically steel price volatility. To mitigate this, Interarch maintains about 2 months of physical inventory and 2 months of supplier coverage. This gives them 4 solid months of price visibility, allowing them to pass on price fluctuations in new orders and protect those crucial gross margins.
So, that brings us to the ultimate question. With virtually zero debt, a massive 84% profit CAGR, peak capacity utilization, and a robust 1,600 crore order book, is Interarch Building Solutions the ultimate proxy for India's infrastructure supercycle? We've laid out the numbers and the analyst views. Now it's your turn to dig deeper. Thanks for joining us for this explainer, and keep learning.